Hello, everyone, and welcome to another edition of the Smart Investor Podcast, where smart investors get their up to date price analysis and market information. Market continues to rally into resistance. That is the theme of this podcast. And just before I get started, remember, if you'd like to see the chart analysis, you can go to smartinvestorcentral.com and go to market updates, and you'll see the charts that I am speaking about. I hope everyone is doing fine. And what I'm looking at now is a daily chart of the S&P 500 and the S&P 500 futures. And we're seeing that the market is moving to new highs for the month of May. And actually, if I'm not mistaken, the market is currently at new highs for the year. We started the year off at 2037.90, and we're currently at 2059 on the year. So we're positive for the year on the S&P 500, just barely, but we're still positive for the year. Now, what is ahead of us? That's what we're going to take a look at in terms of the rally in equity markets, and also what's happening in the dollar, the gold market, and some other commodities. Okay, so taking a look at the S&P 500, we're currently, S&P 500 futures, as I said earlier, is currently at the 2059 level. Now, what we're coming up on is some areas of resistance, and these resistance areas in the past serve to stump the rally that occurred. We have a resistance area near the 2060 level, and also one near the 2100 level. So we are coming up into an area in the S&P 500 that traditionally has been fairly strong resistance. Now the question is, can the bulls muster the energy and the buying power to push the market above these resistance areas? And what I'm doing is drawing a trend line above the resistance areas that my viewers who are looking at the charts can see. And this trend line will come in at around the just below the 2100 level on the S&P 500. So what I'm going to be doing is keeping an eye on these levels. If we push above these levels and can go to new highs, that will be very bullish for the markets. If not, if the markets fail up at this level, what we could see is the market actually challenge again the bottom of this consolidation. So the broad consolidation area, meaning when I say consolidation, it just simply means the markets are essentially trapped between two price points. We're trapped between roughly 1800 and the high of and about 2150. So between 1800 and 2150 on the S&P 500, the market is in a consolidation. It's actually trapped, and we'll get clues as to the way it will break and the future movement on the market, on where the market breaks out of this consolidation level. So that's what I can tell you most professional traders are looking at now. I mean, most fund managers, they are looking at this consolidation in the S&P 500, and some are waiting to see which direction it will break. And if it breaks to the downside, we can expect a fairly strong move to the downside. And if we break to the upside, we can expect a fairly strong move to the upside. And the reason why we can expect a strong move is that it's the length of time that this market has been in this consolidation. Okay, taking a look at the cash S&P, the cash Dow, we see that the market is currently in a consolidation similar to the S&P 500. And we're coming up into the 18,000 level on the Dow. We're currently at 17,633. The market is opening, or the futures are pointing about 80 points higher or so. So 17,000, let's call it 17,700. So we are within 300 points of the 18,000 level, which has rebuffed the market already on a number of occasions. In November, we saw the 18,000 level act as strong resistance, and the market declined into the 15,600 level. We're coming up on it again, and it will be interesting to see if we can break above 18,000. And if we do break above 18,000, the next area of fairly strong resistance is the 18,350 area on the Dow. So point of it is that we're coming up into an area where traditionally we have seen selling pressure come into the markets, and we are going to definitely be keeping an eye out on that. Taking a look at the Nasdaq, we see that the market, let's go to the Nasdaq futures. We see that the market is pointing higher this morning and at the 4,488 level. And we're coming up into resistance at the 4,700 level on the Nasdaq, and that should act as pretty strong resistance for the Nasdaq. So to summarize, the equity markets, we're just in an area of resistance, and it will be definitely a good strategy to be cautious up at these levels. Turning overseas, let's take a look at what's happening in the German DAX. The German DAX has rallied off of the bottom. The market bottomed out in mid-February, and we're currently at the 9,000, in the 9,000, just shy of 10,000 on the German DAX. Now, we're coming up into resistance in the 10,000 to 10,400 level on the DAX. So we can expect sellers to be lining up around these levels in the German DAX. Currently this morning, we see that the German DAX is up 174 points at 10,062. So we're coming up into definitely strong resistance level. Taking a look at the French market, the CAC 40, we see that the market is currently trading at the 4,449 level, and resistance in the CAC 40 is at 4,600. So we'll be keeping an eye on that area of resistance. UK FTSE market, that people have been saying that I have been beating up on and highlighting the weakness of the FTSE. We see that the market currently is trading at the 6,200 level, which traditionally has acted as resistance. We saw that the market in March, the markets cannot seem to come above the 6,200 level. 6,200 to 6,300. So I'll be looking at this area with some keen interest, and if we do fail from here, that will be a good short opportunity for the FTSE, or if you're not inclined to short the market, just a good area to be looking to take some profits in the UK FTSE. The FTSE chart still looks fairly weak because, as far as I'm concerned, we're in a bear market with the FTSE, and we're seeing a series of lower highs. We're seeing a series of lower highs and lower lows in the markets, and that is what we call a bear market and in the FTSE. Now, moving on to the US dollar. US dollar this morning is challenging support at the 94 region on the US dollar index. But US dollar index is still trapped in a broad consolidation pattern. And during times of consolidation, the markets can be fairly choppy. And if you are following a trend following type of method, your account could get chopped up a bit until the markets really start to reassert themselves and start to trend again. US dollar index has been very choppy over the last couple of months, and we could see what we're looking for as market participants is to see if the market can break below the 92 the 92.50 level on the US dollar index, or above the 100 level. If we do close above the 100 level, and I will be looking for a weekly close above that level, that could be fairly bullish for the market, for the US dollar, and we could see tremendous gains from here. If we do close below the 92.50, that would be bearish for the US dollar, and we could see the US dollar decline pretty significantly from here. So with the US dollar, as with S&P 500, we're in a consolidation pattern, and we're just waiting to see which direction the market will break. Quickly looking at the euro currency versus the US dollar, this is the cash market. We're coming up on an area that has, in the 114 level, that has provided some resistance in this market, and the market is currently backing off of that level. If we do back off of that level, we could see the euro trade back down to the 108 level. If we close above 114, we could see the euro challenge the high that was made in August of last year in near 117 to 1. So euro currency, definitely good to be looking at and see what's happening in the market. Gold market. Many have called that there has been a breakout in gold, and gold is going to skyrocket from here. We did see some initial signs of a break, in that the market did close above resistance in the 1200 level, 1200 region on the cash gold. But the market has fell short of the 1300 level in gold. And actually the market topped out just shy of 1300. So for the bulls to regain some momentum, we need to see this market trade and close above that 1300 level. That 1300 level in the cash gold is critical resistance. A close above that level could signify that this market has turned around, and where we would start to see, or we could start to see, a series of higher highs and higher lows in the gold market, and the bullish market in gold could commence. If the market does not trade above that 1300 level, and we close below 1200, we could see a strong sell-off in gold that we could challenge the 1120 region and also the 1080 region in gold. So definitely, to summarize, definitely we are not in a bullish environment yet for gold. I know I read many bullish prognostications daily, but I would say the market is neutral at this point in time, and we need to see the market close above 1300 to become really bullish. And if we close below 1200, that would be bearish, and the market could return into the 1100 handle. Looking at the silver market, looking at the futures in silver, the market is currently at just around the $15 handle. And similar situation with gold. The critical resistance in silver is above the $16 region. Let me highlight it here on the chart. A close above 16, let's call it $16.50, will be fairly bullish for the silver market, and we could see silver regain a bullish prosper. And remember, silver did top out near the $50 region. So if we do close above $16.50, there will be a lot of room to grow in silver, and we could see the market really accelerate to the upside. As long as we remain below $16.50, the market posture remains slightly bearish. And if we do close below the $14.60 level in silver, that would be very bearish, and we could see the market turn and try and challenge the $13 region in silver. So if I was looking to buy silver, I wouldn't be interested until the market closes above $16.50 on the cash, on the futures market. Looking at the crude oil market, Oil has had a wonderful rally. We're up again this morning in the $39 region, and what I would want to see for this rally to regain legs is the market close above 42. As long as if we remain below 42, we're at risk of another down wave in the crude oil market. And if we close below the $37 region, we could definitely be seeing lower prices in the oil market. So that is definitely something we'll be looking out for in crude oil. Okay, so just to summarize, the equity markets are essentially in a consolidation pattern at this point in time, and it's very important to keep an eye out on what the prices are telling you, because the last time the equity markets were in a consolidation type pattern, and for some period of time, it marked the top of the market in the 2007-2008 top. For those of you who can see the charts, let me just quickly revisit 2007, 2008. We saw that the market took some time to top out. A lot of folks said that the market caught them by surprise, but that if you pay attention to prices and price analysis, you saw that the market took a number of months to actually top out. We saw that in 2007 the market rallied up, the S&P 500 rallied up to the 1500 region. Market went down, went up again into the 1500 region, and we did have a consolidation area that the market consolidation area between 1400 and 15,700 or so. And once we saw the market break below that 1400 region into the 1350 region, that's when we saw the market break below the consolidation, and we saw the huge sell-off that occurred. So market tops don't just normally top out all of a sudden. We normally see some sort of consolidation, topping out action that can take a number of months before the markets actually break to the downside or to the upside. So that is what happened in the S&P 500 in 2007-2008. And we could be seeing, we could be seeing a similar situation now with this current rally. And this market could be in a topping out region. As I said before, what would negate that is a close and a rally above the 2133 level in the S&P 500. Okay, I know there's a lot of uncertainty in the markets, but thank you very much for listening to the podcast. And as normal and as always, we will keep you abreast as to what is happening with the price action and what prices are telling us, and not paying attention to what the mainstream media is telling us, because the mainstream media normally catches these things very late, and it's good to stay ahead of the markets and not follow the markets. Thank you very much for listening, and I hope you all have a wonderful day.